All right, today we have another stock analysis. Today we're going to look at the Campbell's Company. Now, as you may have known, the Campbell's Company is in the news, but not for the right reasons. Recently, their executive made some comments that has some investors kind of looking the other direction. But we're going to look to see if this stock has been sliding enough over the past few years to warrant our attention for a possible investment. So let's get right into it. So the Campbell's Company, ticker symbol CPB, trading right now at $28.74, $28.50 on after hours. And look at the past few years. This stock has been sliding down since 2020, late 22, sliding down from looks like about above $55 now to $28. So we're looking to see, is this stock cheap enough to buy? Now let's look at a few stats of this business. Market cap of $8.5 billion. PE ratio 14.8. Now, this is a very mature business. Typically, I don't want to buy a business like this at this high of a PE, almost 15 times earnings, especially if the company isn't growing rapidly. So we're going to take a look at the revenues to see. But I think here's the main focus for many investors. You have a dividend of $1.56, but that's 5.4%. So that's a very high yield for a common stock. So we'll look to see if that yield makes sense and if we are interested in this company. And if not for growth, definitely maybe this is an income investment for those that are interested in that. So let's start off looking at this business segments. How is their business structured and how do they make their money? So Campbell's is 27% soups, 43% baked snacks, and 30% beverages. That's how they bring in their money. Now, I want to point out something that's very important here when it comes to their snacks. If we were to look at their number one segment, their largest segment is the baked snacks. We see over the past few years, 4.6 billion in revenue, 4.5, 4.4. So their number one segment, baked snacks, is starting to come down. So that is a sign of some weakness that investors are seeing, and some of them are running away, causing that stock to slide over the past few years. So they definitely have some challenges to beef up this segment and get it going again, because right now it's sliding. So whether that's going to be more healthy snacks or whatnot, they have to do something to address this problem. So there is some risk embedded with this investment there. Now, looking at the revenues, again, we're talking about a mature company. We're not talking about a new hot tech stock. So we have to make sure that we are having reasonable expectations when we're looking at the revenue and the margins. So 2016, 7.9 million in revenue, 2025, 7.9 billion, 2025, 10.2 billion. So you do have some growth, but it's not steady growth. As we see, we have 1, 2, 3, 4 years where revenues were down, but overall uptrend, looking at about 3.4% growth per year over the past 5 years, which can be expected for a very mature, established company. So let's look at margins. Gross margins, after they create their product and deliver it to the customer, how much money is left over? We're looking at 2.7 all the way to 3.1. So here's a trend that we don't like to see. We want to see either improving margins or steady margins, but we have 34.9. It is becoming more expensive for this company to create their product, and they are not finding efficiencies to do so, to combat the increased expenses. So that's something revenues looking good, gross profit, we don't like to see that. Now, looking at net income or net profit, after they deliver the products to the customer, that's the gross profit. After they paid for all of their selling, administrative expenses, all their leases and things like that, now we're looking at the net income. What's left over after all expenses are paid? With 560 and have a high year here in 2021, over $1 billion, and back down to 602. But the margins are a little bit all over the place, but they're not bad. 7.1. This is the lowest year, 3% here, up to 11, 8, 9, 5, 5. So again, no years of losses. They have a profit every year, but the profit isn't growing. So it's not the most attractive. This is probably neutral here. Not good, not bad, but kind of right in the middle. So revenues are looking okay. Gross profit trending in the wrong direction. Net income, so-so. So let's look at the debt. This is another one that could be a sign of, that could raise some alarms. So we're looking at how much debt do they have and how much cash flow do they produce each year. And we want to know how many years will it take for them to pay off their debt, looking at their current cash flow. So we want it to be under 5 years, 3 years the best. If not 3, then 5 is okay. But they're at 9 years before they can pay the cash flow. So that means when they have cash flow of $705 million, they have debt of 6.3. So it's 9 times the amount of cash flow is sitting on their debt. Now, when companies get in trouble, and I wouldn't say Campbell's is in trouble right now, but when they do get in trouble, we want below 5 years. So we want a company to be able to pay off their debt quickly to help them stay afloat. So right now, if they were to get into trouble right now, they would not be able to pay off their debt in a fast enough time to stay in that safe range. So that's something that we have to keep our eye out on if you're looking at this company to invest. Looking at the dividend. Now, would be the most attractive attribute of this company. Again, we talked about that high yield, over 5%, which is great for a common stock, especially one that has growing revenues, even if moderately, like we see with Campbell. So over 5.4% dividend yield, payout ratio, 66%. So out of all their cash flow, 66% of it is paid out to the investors in a dividend. This is not what we like to see if we're looking at a company that's going to aggressively grow their dividend. But this is okay for a company that's established and has a steady dividend. Again, that 5.4% is pretty solid. You shouldn't look for more than that unless you're investing in some type of income fund or some type of a real estate investment trust. 5% is at that top range of what you should look for a healthy company. So again, income of a company that's growing their revenues moderately and also a payout ratio that's not bad, but don't expect this dividend to grow a whole lot in the future. Shares outstanding. This is important because we want to know when a company has cash or free cash flow, one of the things that they can do is that they can buy shares. They can repurchase their own shares. When they do that, it increases the value of the remaining shares. So this is one way that companies can add value to the shareholder. The dividend is one way. Of course, reinvestment into the company and for greater profits is another way. And shares outstanding. When a company buys back their own shares, the remaining shares become more valuable. So we want to see a downtrend if possible. So we see that with Campbell's, and you should expect this with any mature company, that they are taking cash flow and buying back shares. We see they had sold some shares and bringing some cash in 24, but they're back down in 25. So we like to see this downward trend of share buyback. So again, 21, they went up again, but again, rebounded 22. So it looks like every few years they might sell some shares to bring in some capital, bring in some cash for the business. But the year after that, they continue to buy back shares with profits. So overall, this is good. Now, value added. What are we looking at right here? I want to know, out of all the capital that the managers have, whether this is from equity, selling shares, profits from prior years, or debt that they're grabbing from financing, what's the return on that money? I want them to produce a return, and I want that return to be over the cost that it costs them to have that money. So if it's debt, it's going to be interest. If it's cash that's on their books from prior years of profits or selling shares, there's an opportunity cost where the company could invest in that business, or they could take that money and invest it in the market at about 10% average. So that's what the thresholds I use to measure what is the cost of the capital. The cost of the capital sitting on your books versus the return that you're getting for using that capital. So I want to know, is the company adding value each and every year? So over the past 5 years, they're averaging about 13% return on their capital. Compare that to a cost of capital of 3.5. So on average, they're creating value at about 9.4% per year. This is solid. So this is a nice spread of returns above the cost of doing business. So I like to see that. Now, lastly, let's look at the valuation to see if we believe Campbell's company is priced well enough to warrant some attention. Are they overvalued, undervalued, or fairly valued? So they are expected to grow at about 2% a year. So again, not very high growth. And we saw at the beginning of this video how the baked snacks, their number one segment, is starting to shrink a little bit. So they would have to make some changes to grow this company substantially. But right now they're expected to grow very low, 2%. At a discount rate of 3.6, which is about their cost of capital, with a mature company that's not growing very much, I would not expect that if I was to buy this company now, that I can sell it for more than 10 times the free cash flow. So right now, just for reference, they're trading at 12.2. So this is their free cash flow now. It's trading at 12.2 times that. I would not expect more than 10. So with those inputs, the share price is about $28. I think this stock is worth about $30 per share. So I would say the fair value range is between $27 and $33. So they're right in that pocket of being what I would consider fairly valued based on my assumptions. Now, just for reference, of course, if you believe it's worth more, going to grow more, you would assume that the intrinsic value is higher than what I have. But I will say that my valuation is pretty much in line with other people are saying. It's kind of right at that fair value mark. So not a deep discount, but you're not overpaying for this stock. But again, you have to keep in mind their number one seller, the baked snacks, is on a downtrend right now. So what are they going to do to address that? And also their debt. They have what I would say too much debt on their books right now, especially for the position that they're in. So I would expect them to take a lot of that free cash flow and pay down debt instead of growing that dividend aggressively over the next few years, just to get them in a solid position. And they would have to make those changes along with addressing their number one product line going down. So that's my evaluation of this company. I think they're right at fair value. So if you were to buy now, you should be safe, especially with that 5% dividend yield. So in my opinion, if you're interested in investing in this company, this would be solely a dividend income investment. This is not something you invest in expecting a lot of capital long-term growth. So people who are nearing retirement or people who want some type of solid, consistent income in a Roth IRA where they don't have to worry about taxes, they can just accumulate, they can just reinvest those dividends. This would be something that I would consider for that. But again, I think there's more businesses that are presenting greater prospects, more growth, pretty solid dividend yield with a lot more dividend growth potential because those businesses still have some growth ahead of them instead of Campbell's right now. So if Campbell's can reinvent themselves a little bit and create something to help solidify their position, then I would say Campbell's will move up in that spot. So that's my evaluation of it. Let me know what you think about this company in the comments. Let me know what you think about the valuation, and I hope to see you in the next video.